Good afternoon. Very good afternoon to all of you, and welcome to today's session on purchase price allocation and intangible asset valuation. Today, along with me, I have CA Arun Gupta, who qualified in 2022, worked with Deloitte and RSM USI earlier, and now Arun is our valuation lead, leading the valuation practice of the firm. Welcome, Arun, to the session. The topic is very interesting. Purchase price allocation. We all know that when any acquisition happens, the total price is agreed, and then allocation of that price into tangible or intangible asset is basically the purchase price allocation. And the intangible assets which are coming in that acquisition needs to be valued. So today's topic is focused on when the acquisition happens, how to allocate the price among different assets and specifically with regard to intangible assets. So now, warm welcome to all of you once again, and over to Arun for his deliberation on PPA and tangible asset valuation. Thank you.
Thank you,
Arun,
Gaurav, sir, for the introduction. So before I start, I will just present my screen.
Arun, you are able to share your screen?
Yes. Can you all see my screen now?
Yes, screen is visible. इसको you can put it on a presentation mode. Yes.
Yeah. Okay. So, good evening, everyone. So as Gaurav sir already pitched an intro that today's session will be on the intangible assets and the PPA, purchase price allocation. So PPA generally sits at the intersection of all the M&A deals, valuations, and accounting standards. So we will try to keep the session more practical from practical standpoint, and we will also discuss some theory in between the session. So let's moving on. So generally every deal closes, and at the same point, there is a question whether this deal triggers a PPA, whether this deal needs a purchase price to be allocated between the assets. So generally for this, we need to check in Ind AS 103, uh, which says every time there is a business combination, that is transfer of control from one entity to another, there is a requirement for a PPA exercise to be done. Generally, this PPA exercise is performed through the acquisition method, which we will discuss later in this session. But there's a misconception that generally a PPA exercise is only done when a business is acquired. But this is also done when a business undertaking, a part of a business is acquired for a lump sum money. But the condition is such slum sale should qualify as a business as per the accounting standards. I may not be a accounting expert, but generally there are three conditions to qualify as undertaking as a business. There should be some inputs, there should be a process in the business, and then out of that process and using the input, there should be output. So ideally, there are two instances where a PPA exercise is required when a business gets acquired or when there's a slum sale. Now, let's see when the PPA is not required or when there is an exemption. So there are generally some common control transactions also. To understand it better, let's say company A has 100% control in company B and company C. So in terms of in going into restructuring, company A plans to sell its stake in company B to company C. Now, company C is sub-subsidiary of company A. Company B is sub-subsidiary of company A. So now there is no change in control. Ideally, in the even the previous structure, company A was controlling both the entities. Even in the revised structure, company A is controlling both the entities. So in such a case, there is no PPA exercise required. Even in the joint venture arrangements, where there is no transfer of control or there is no control at both the parties, the PPA exercise is not required. So even when there's always a discussion that PP exercise is required, there's always also a discussion that do we need to close the PP exercise at the transaction date only? But there is a relief or there is a time period specified in the accounting standards uh, in which you can finalize the PPA numbers. So generally, this period is 12 months in which you can finalize the PPA numbers. But meanwhile, there will be interim results also, there will be annual results also, in which you can use the provisional numbers per se. And if there are any changes lately in within the 12 months period, you can route them through the opening balance sheet of the acquisition of the target company. But in case that 12-month period has lapsed, such changes generally route through the P&L of of the acquirer. So now, since we have learned when the PP exercise is required, let's also deep dive into what is a PPA, what is the purchase price allocation. So generally, purchase price allocation in very simple words can be termed as it is an allocation of the purchase consideration of any acquisition between the tangible and intangible assets of the business, and any residual is generally termed as goodwill. So simple equation, uh, a company has working capital also, company has fixed assets also, but a purchase consideration can be higher than those fixed assets and working capital. So in that case, the residual portion generally can be termed as goodwill. But we need to understand the business that there might be a brand in the business, there might be customer contracts in the business. So such customer contracts, brand should be recognized and measured. And post these three reductions in the purchase consideration, there is a goodwill value, or there can be a bargain purchase as well if such assets are higher than the purchase consideration. So when we were discussing on the trigger points in the Ind AS 103, we also saw that acquisition method is used. So now what is this method? It is a five-step method which is generally followed in a acquisition. You need to identify the acquirer first. So this seems simple, but in a very complex transaction such as reverse merger transaction, it gets complex to even identify the acquirer first, because such PP exercise is done by the acquirer to basically merge the target's balance sheet in its balance sheet. The second most important step is determination of the acquisition date. So generally, the acquisition date is a date of transfer of control from one entity to the other. There are some conditions related to it. I think control can be 51% ownership. Control can be majority seats in the board. So we need to determine the acquisition date. Then the third step comes in. Uh, we are discussing that purchase consideration needs to be allocated, but firstly, we need to calculate the fair value of the purchase consideration as well. So, what can be the components of a purchase consideration? So, I think everyone knows that cash can be one of the components, shares can be the other component. The third component of a consideration can be a contingent consideration. So, contingent consideration is type of consideration which is subject to future events. Uh, for example, these events can be linked to the promoters of the key managerial persons in the target company staying for next 3 to 5 years, or it may be linked to the performance metrics of the company in the future years. And the consideration linked to the performance metrics are also generally termed out as earnout consideration as well. So such consideration, the contingent consideration also need to be fair value as at the valuation date. So there are general scenarios how they are valued. For example, there can be a target that if a company crosses 100 crore sales in next 3 years, then the seller would get a 5 crores in purchase in the consideration. But how to calculate the fair value? We generally allocate the probabilities. We create scenarios that 30% chance that it will cross 10 crores of revenue, 50% chance that it will cross 4 crores of revenue. Then there is a discounting of the weighted average or the probability factored value to calculate the fair value of the consideration as on the valuation date. Then, uh, coming the most interesting part of the VP exercise, we identify the assets which sits in the balance sheet. They're clearly visible in the balance sheet. But the second part comes in, we need to identify the intangible assets that a business has. So once we identify the intangible assets, we need to measure those intangible assets. Uh, we need to assign a value to basically merge that intangible assets value in the balance sheet. So once we have the tangible and intangible assets fair value and the purchase consideration fair value, the last step comes in where we calculate the goodwill or we categorize the sale as a bargain purchase and then the negative balance goes into the capital reserve. So when we have learned what is PPA, I think the next topic that we have I've repeatedly said in the 10-15 minutes of the session is the fair value. That purchase consideration should be at the fair value, asset value should be at the fair value. But what is fair value? Where this definition is coming from? So Ind AS 113 helps out here. So Ind AS 113 has defined fair value as a price received to sell an asset or paid transfer a liability in an orderly transaction between market participants at a measurement date. So this whole definition seems a bit complex, but let's break it into six main key terms. The first is it is not referring to the entry price, it is not referring to the transaction price, it is referring to the exit price. For example, if you want to sell an asset, how much you will get, and if you want to transfer a liability which you're obligated to pay, how much you will pay it right now. The second key term is the transaction should be an orderly transaction. So now what is orderly transaction? So orderly transaction is a transaction which is not forced, which is not distressed, which is not a liquidation sale. Why? Because generally in these transactions, the fair value can't be determined. The buyers and the sellers may not be rational while thinking, while putting a price to the assets. So the transaction should be orderly. Now, the third key term is the transaction should be between market participants. So, what are market participants? And both buyer and seller should be knowledgeable, should be intelligent, should be willing, buyer and seller. So, a price could be a fair value only and only if the market participants are entering into a transaction because a specific buyer may put a different price for its own use. But a market participant would only put a price what a whole market or a whole set of buyers would pay for one asset. Now coming to when we have discussed that it should be the exit price, the transaction should be orderly and there should be market participants. But we are late to discuss what type of market should be there and which market we should look for the price. So the market should be most the principal market or most advantageous market. But there's a hierarchy that India generally has defined. So first we need to look at the principal market. Principal market is a market where there's the highest volume and there's highest activity. But generally, uh, you may not always find a principal market for all the assets. Then you have to look at the most advantageous market. Most advantageous market is a market where you get the maximum price net of transaction costs. So next, what type of use we are looking at? So the asset under valuation should be at the highest and best use. So, for example, a pen might not be maybe of a different use for me, but maybe of a different use for another person. But we should always be looking at its highest and best use, where the maximum value that asset can derive from. And such use should be legally permissible, financially feasible, and that use should be possible, technically viable also. So when we have discussed these five terms, which sits in the definition, uh, there is a hierarchy in which Indians has structured out, which we need to look at while valuing, while putting up a fair value. So 11.1 generally is a very simple one, where you need to look at the quoted price of the assets in the active market. So generally the listed shares can be termed in this category. Second is the observable inputs, like a company got sold for 100 CR maybe and operating in a automotive segment. So for setting a price for another automotive company, we can look at that transaction. We can obviously apply the risk adjustments, profitability adjustments. In level three, where the intangible asset valuation and the whole PPA exercise sets in, the unobservable inputs. Some of the inputs wherein such as forecasts and assumptions about the business come in from the client, from the target side, and the rest of the assumptions we valuers uh, take in to drive the valuation of the intangible assets. So when we have discussed the fair value also, the PPA also, so now the most important term why we are here, what are intangible assets? So I've also tried to present it, the differences between all the three frameworks and accounting frameworks. One is INDES, second is IFRS, and third is US GAAP as well. So intangible asset is an identifiable non-monetary asset without physical substance. So what is uh, identifiable asset? So identifiable asset is defined by the index as either it can be separable from the business or it arises from the contractual or the legal rights. When we talk about it should be separable from the business, we are referring to it can be sold, transferred, licensed by the business to any other party. And we are referring to the contractual right. So there can be a customer contract with someone. There can be a vendor contract with someone. So then there is a contractual right to the business to serve that party or or purchase the goods from that party. The second key element of the intangible asset is there should be control over the asset. Third key component of the key term of the definition is there should be future economic benefits from the intangible asset. So, for example, uh, let's say there is a CA firm operating from last 20 years, and now they have a set of clients which they're dealing with, I think, from last 10 years, last 15 years. There are no contracts with them. They have a relationship with them. They have a customer relationship with them. So ideally, that customer relationship can be transferred to any other CA firm also. Second, they are getting the future economic benefits. Third, they now have a control also on the cash flows that they get from those clients. So ideally, customer relationship in the manner can be an intangible asset. Now, just comparing the India's definition with the IFRS and the US GAAP, there are no as such differences between all three. The differences comes in when we talk about the internally generated asset and when we have incurred research and development cost in there. So as per IFRS and Ind AS, the research expenses are generally expensed out to the P&L, while development expenses are generally capitalized. And in the US GAAP, whether it's developmental expense or whether it's research expense, it is expensed out in the P&L. Now, the second difference comes in revaluation uh, of the intangible assets. So, Ind AS and IFRS permits the revaluation if there is an active market, but US GAAP keeps it on a cost model only. So, we will take a pause. We'll wait for any questions if any of the viewers have. Taking silence as there are no questions as of now. So generally, the moving forward, so intangible assets is a broad has a broad definition, and there are common five categories of intangible assets which can be classified. Um, so first category is the marketing-based intangible assets. So what does this include? Uh, Either they can be trademarks, either they can be trade names or internet domain names, and they generally have a major chunk in the purchase consideration for a B2C brand. So, for example, Adidas may be manufacturing a same shoe with the same quality as a vendor, hypothetically, but still Adidas would fetch a premium price than a local vendor. So, whenever the Adidas brand would get valued, it will take a major part in its whole business or the business valuation or the entity valuation. The second category is customer lists, customer related intangible assets. These generally include customer list, customer relationship, order backlog. So, what is order backlog? Order backlog is nothing but you receive the order, you signed a contract, but no cash is yet received by the business. So, customer relationships and the customer list order backlog are generally valued using the MAME approach, multi-period access earning method, which we'll discuss later in the session. The third category of the intangible assets are the technology-based intangible assets. So there's a myth that only the patent technology should be valued, but I've seen unpatented technology also getting valued. Trade secrets also getting valued, software, technical know-how, databases. So since in the modern era, data, the person has a data, the person has a mind. So the databases can also be sold. So they are generally categorized as technology-based intangible asset. So there can be the fourth category is the contract-based intangible assets. Generally, a business might have a license. Uh, they might have royalty agreements to use a brand. They might have a franchise agreement. They may sign a non-compete with some of the key managerial persons. So they all are grouped under the contract-based intangible assets. The fifth category, which are leased in any PPA, is the artistic-based intangible assets. These are generally copyrights to the books, to the films, to movies, to photographs, to videos. So until now, what we have discussed, I've just factored into a example. Um, Describing each step what we have discussed. So there is a transaction wherein Sun India is 100% acquired by the Earth India. So first, the control is transferred. There is a business combination. Ideally, a PPA is required. So now we need to identify the acquirer. The acquirer is Earth India. Uh, Second, measurement date can be the acquisition date or date of transfer of control. The third, fair valuing of the consideration. So, consideration here in this example is divided into three parts: cash of 30 lakhs, shares of 15 lakhs, and a contingent consideration component of 5 lakhs, which is at fair value based on our assumptions. Now, we need to identify the net assets in the business. So the business have a net working capital of 12 lakhs, fixed assets of 18 lakhs. So the total net assets of a business, excluding the intangible assets right now, are 30 lakhs. Now, the Sun India might be a B2C brand. It may have a brand value, and then it may have a technology using to serve its customers. So we identify those two intangible assets in the transaction. We use relief from royalty method for the trademark and replacement cost method for the technology to get a value. Now we sum total all the tangible and intangible assets value. We get to a 38 lakh 34,000 value. Now, if we reduce this net asset value from the total consideration, the remaining figure is the goodwill of the transaction. So one can question, and at what does this goodwill represent? So generally, a goodwill in a transaction represent the assembled workforce value subsumed into it, some buyer-specific synergies, and there might be some assets which may not be material to the transaction, which the valuer may not have value, and with discussions with the management and the auditors. So such assets also get subsumed in the goodwill component. So moving on, we have seen that there are multiple types of assets, multiple type of intangible assets, and we also saw that the two methods that we use to value the brand and the technology. But the all the methods to value the intangible assets are broadly categorized into the three approaches. The first is the income approach. So income approach is nothing but a DCA valuation, where the future economic benefits or the future cash flows of a business are discounted as on date to get a present value. But the the basic DCF can't be used to value the intangible assets. So there are general tweaks to these methods which have been made. And then there are four methods which we use to value the intangible assets. The first is the relief from royalty method, which is used for brands, trademarks, trade names. The second is the multi-period excess earning method. These are generally used for the to value the primary asset of the business, the lead asset of the business, such as it can be customer relationship, it can be technology. The third method, which comes in under income approach, is with or without method. So, with or without method is taking an example, it will help us better understand it. So right now, Virat Kohli is playing with RCB. It has a player contract with the RCB. Now, to put a value to the contract, to his contract, what how we can do that? We can first check what are the earning or the cash flow sources for the RCB. I think they are generally ads, broadcasting rights, uh, which they get. So we take two scenarios here. One scenario with Virat Kohli in RCB team, what cash flows with the RCB team would fetch. The second scenario, that if the Virat Kohli is not there with the RCB, what cash flows it could fetch. So there would be a delta between the two. The with approach will definitely have a higher value, will have a higher cash flows than the without approach. That delta is now discounted as on date to calculate that value of the player contract. And this method is generally used and is commonly used in the industry for valuation of non-competes. That I said, for valuing in the player contracts, for valuing the KMP values. And the fourth method is a distributor method, which is generally a tweaked version of a multi-period excess earning method. Uh, just one or two differences are there. But I think first we will cover the multi-period excess earning method, and there I can plot the one or two differences in between. The second approach to value the intangible assets is the market approach. But since uh, first let's discuss it, then I think we will also discuss about the use of this method, of the methods in it. So there are two methods in the market approach. So the first one is the guideline transaction method, and the second is guideline company method. But both of the methods are very scarcely used in the PP exercise, because there are no or very less transaction where only an intangible asset is sold in the market. So you may not find a transaction, you may not find a company with a nature or specific to a specific intangible asset. The third approach comes in here is the cost approach. There are two methods under the cost approach. One is the replacement cost method, which is generally used for assembled workforce, and the second is the reproduction cost method, which is used for valuing technology or the software. So the production or the replacement cost method are based on a premise that uh, how much a company would spend or how much it will cost to a company to build the same asset as on date with the same condition of the asset. So that is a premise, and now we have discussed in what are the three approaches and what are the methods under each approaches. We will be covering the top two methods which are generally used in a PPA exercise, rotary form royalty and multi-period exercising method in the session going forward. But we will wait for a minute. If anyone of you have any question, we can address it.
Yeah, hello Arun, Raj this side. Hello, I'm audible.
Yes, Raj, I can hear you.
Yeah, so my question is regarding the like practical PPA assignment. Whenever we start working on the PPA assignment, how the client provides generally the asset values, like how they determine the fair value of the assets. Like for example, I'm using one plant and machinery. In the practical life, can you explain a little bit how they determine that its fair value? Means they appoint the valuer for plant and machinery or what? Like
So generally, the plant and machinery is a depreciable asset. So first, a discussion would be held with the company, with the management, whether they consider the depreciated asset value as a fair value uh, of that plant and machinery. So generally, in mostly cases, the depreciated value is the fair value because uh, there would be a wear and tear, actual wear and tear of the plant and machinery as well in there. So ideally, the depreciated value only presents the fair value of the machinery. But in some cases where management is of a different view, along with the value, then generally a plant and machinery valuer gets into the team and he gives a separate valuation for that plant and machinery, which is used in the PP exercise by the valuers like us who is doing the intangible assets valuation.
okay, so like whatever you said in the like valuation for intangible assets, it's with and without method. It is same as like with method is same as value in use.
No, value, you're referring to value in use, right?
Yeah.
Raj, can you repeat your question or put it in the chat box? Actually, your voice is coming very
Mm,
low.
yeah. So what I'm asking is value in use and with and without methods are similar, yeah, or they both are different.
They both are different. Actually, value in use is one of the two approaches for the impairment purpose exercise, whereas one is fair value less cost to disposal, and one is the value in use. But with and without method is specifically for the intangible assets valuation, while value in use for is for the valuation of a undertaking or a reporting unit or a CGU for impairment purpose.
So what I want to ask is, like, means intangible assets like patents or like patent, for example, it does not have a value in use. Like whenever
No,
we do impairment testing as per
hmm,
ASC 718, so when client also provides the cash flows for the purpose of valuation of particular in like intangible asset, right?
yeah.
So what I want to ask is like that you talk about with method. Like I sound it sounds similar to the value in use.
Yeah, it sounds similar, but at the same point, generally, when you get the cash flows, it should be totally attributable to the intangible asset. Basically, then the value in use and the with method would give a same value. But in case you are valuing the whole business, then there you can't get the intangible asset value what you will getting in the value.
Okay. Anyway, I just want to ask that in the whenever we will calculate value in use, which discount rate we use?
So generally, the discount rate is calculated on the market factors. There is nothing specific discount rate there. I think first you need to calculate the cost of equity and see what financing or how the business operations are financed. There is no specific rate. Uh, we have to see the risk and return profile of the asset also.
Means we use the cost of equity or weighted average cost of capital that I want to ask.
So, so if that asset or the business is financed by both debt and equity, and then I would use a WACC. But if the asset or the business is only financed by the equity, I will use cost of equity. Also, I can have a look at the similar assets or a similar business profile in the industry, and I think a WACC or a discount rate generally should be based on a market participant approach. So if the companies have a in the industry have a capital structure of 1% equity, I would definitely take a cost of equity and would not go for the target entity specific rate.
So it will be pre-tax or post-tax?
Depending on the cash flows, if the cash flows are pre-tax, the pre-tax rate should be used. If the cash flows are post-tax, the post-tax cash tax discount rate should be used.
Got it. Thank you.
Anyone else, or we can move to the next topic. So moving on. So we will be discussing the first and I think the most complex method of all the methods to value the intangible assets. It is multi-period excess earning method. So the premise of this approach is a business might be earning cash flows from all its assets. So the assets can be working capital, the assets can be fixed assets, might be intangible assets such as brand, technology. So once we reduce the asset return from the total cash flows, we will get a residual cash flows or residual earnings, which might be specific to the intangible assets we are valuing. So generally, and this method is used for valuing the primary asset of the business. And I think based on my practical experience, we have generally seen it valuing customer relationships or technology. So let's take a hypothetical example that a business has a customer relationship, uh, and it also has the other assets. And generally, most of the revenue comes from and the primary asset is the customer relationship only in the company. And generally, it is the case for example, the consulting business or the law firms. So once we forecast the revenue, we apply attrition rate to it. So what is attrition rate? Generally, what we are valuing is the existing customer relationship, what the customer base we have right now. So practically, not 100% of the customer would stay with me in the next 10 years, in 5 years, or even the next year also. So to estimate how many customers will leave in each year, we apply a attrition rate. How it is calculated, we will discuss it later in the session. But there are two methods generally which are used to calculate the attrition rate. Once we apply the attrition rate to the revenue, we get the post attrition revenue, which has already factored the customers which the business will lose in the coming years. Once we have the post attrition revenue, we apply the EBIT margins of the business to the post attrition revenue adjusted for the sales and marketing expense that we will do for the new customers. Because since a sales and marketing expense generally has two components. One, it can be done for the existing customers to maintain a relationship with them. Second, it can be done for the new customers to acquire those customers. So, if we are valuing the existing customer base, there is no case we can include the marketing expenses for the new customers. Ideally, we are not including the revenue from the new customers, so we can't include the marketing expenses for the new customers. There should be apple to apple comparison there. Then we need to adjust those marketing spend in the EBIT margins and then apply that EBIT margin to the post attrition revenue. Then when we apply the EBIT margins, we get the total margins of the business that we will have in next coming years, in the forecast years. So now we will strip out the returns from other assets that the business is earning. So by stripping out, I am referring to the contributory asset charges uh, that the other assets have, that the other assets incur to earn the business sector. So such cap charges can be based on fixed assets, working capital, might be brand and valuation, might be technology, and assembled workforce. Once we reduce these cap charges, there is a post cap cash flows attributable to the customer relationships that we are valuing. So we discount these cash flows at a discount rate. So such discount rate generally is higher than the WACC or the business risk of return. Because first, it is an intangible asset, it doesn't have a physical substance, it has uncertain cash flows. Third, it might have a longer life, and longer the life, the more the return, the more the uncertainty. So generally, a risk premium is added to the business discount rate to get the discount rate to be used for the customer relationships. Once we have the present value of the cash flows, we need to add up a tab factor to the value. So what is tab? It is tax amortization benefit. So once you recognize an intangible asset in your books, you would be deducting amortization in the from the value of the assets, and such amortization will be a tax saving expense. So such tax savings are present value to the current date to calculate the tab value, and an intangible asset value should always factor in the tab value. So when the tab is added, you get the final customer relationship fair value. So what are the key points in what we discussed in the method are: first, the attrition rate; second, adjustment of the sales and marketing expenses in the EBIT margin; third are the CAC charges; fourth is the discount rate; and fifth is the tab which should be factored in. I think I think we can more elaboratively discuss on the what CAC charges should be. So ideally, if you see a working capital is generally for less than a year or up till a year. So a short-term borrowing rate can be used as a cap charge for a working capital. Uh, and for a fixed asset, which is more than a year or maybe longer than that, a long-term borrowing rate can be used. In industry, I've seen a practice that when a RF plus 1% is used for working capital, and RF plus 3 to 4% is used for a fixed assets. And for the brand and for the technology, we can use the discount rate which we're using in their valuation. So even after all these steps, we can make some common mistakes in the valuation. Some of them can be a person can use same contributory asset charges for all the assets without giving the significance to the nature of the asset, the durability of the asset, and how much it is contributing to the business. Second, they might forget to value, they might forget to deduct the assembled workforce cap charges. While assembled workforce is not an intangible asset, it doesn't meet the criteria, but it it generally puts a contributory it contributes to to the return of a business. So such return should be reduced from the to calculate the value of excess earnings from the intangible asset. So moving on to the next method, which is commonly used for the brands, even for the technology, the relief from royalty method. So the premise of this method is, if a business owns a brand, if a business owns a tech, it now have doesn't have to pay the royalty to use that brand or use that technology. So such savings should be present value to the present date, and such present value would be the value of that brand or technology. So how to use this method? So there are 5 steps in this method which we can say. First is, we need to uh, fix a top line revenue which is attributable to the underlying asset. So generally, a business has a brand, and you can't distinguish that a brand only has a 70% of the revenue attributable to it. Generally, a business sells all the goods under one brand. So in that case, the business top line can be used for the valuation under relief from royalty method. But in few cases, it is possible that a business might have two brands. A business might have more than two, three brands. And in that case, we need to attribute the specific revenue, which is specific to the brand, which we are valuing. So once we get the attributed revenue to a brand, we apply a royalty rate, which, as we discussed, we have calculated hypothetically that we need to pay or we are saving because we own the brand or we own the technology. So generally, auditors, when we do the PP exercise, finalize it, the auditors comes into the questions on the PP exercise, and they harshly question the selection of the royalty rate. So how we can support a royalty rate selection? So first, always try to benchmark your royalty rate, what you have selected in the relief from royalty method, from the royalty databases, which can be KT Mine, which can be royalty source or markables even. And you then have a support. And such royalty rate benchmarking can be based on the industry in which the company is operating or the brand is operating, brand strength, the profitability, whether the brand is attracting a premium price or not. So based on these factors, we can determine a royalty rate suitable to the underlying asset based on the industry royalty rates or the existing agreements with the two companies are entering. The second reasonableness check, what we can quote to the auditors in this case is the 25 to 33% profit split test. So a rational management wouldn't pay 25 or 33%, more than 25 or 33% of his EBIT margins would not pay to license a brand or a tech. So it's generally industry practice that if the royalty rate is more than the 25% or 33% of the EBIT margins, the business is already broken and it is not sustainable. So generally, if we have taken it, the auditors would run a sensitivity test and you have overvalued the brand or tech and undervalued the goodwill. So there would definitely be the changes, or there would definitely be a modified or a issue raised by the auditors in that case. So once you have the revenues, once you have the revenue and you apply the royalty rate, you get the royalties that you need to pay or you save. Then, if you are paying the royalties, such expenses are tax saving expense, which need to be factored. So that tax shield will be factored in the royalties, which will increase that royalty, reduce that royalties. Such royalty payments are then discounted using a discount rate. And such discount rate, so in case of customer relationship, as we discussed, that rate is generally higher than the business rate. But in case of brand, such rate is generally at WAC or generally little higher than WAC. But since it is only presenting the business cash flows and all the business sales are related to that brand only, generally the discount rate which you use for the brand is similar to what we have for the business. So now we have the present value of the cash flows as the pre-tab value of the brand. Now, the same thing we need to apply the tab adjustment to calculate the post-tab value of the brand. And we can't miss the tab factor here because it will undervalue the asset. The goodwill will be higher than, and there will definitely be a red flag from the auditors as well. So once we have valued the intangible assets, so there might be questions that how to check or how to put some reasonableness checks that the value and the returns, the discount rates that we were talking about are correct or not, are making sense or not. So there is an exercise which should be every time done in a PPA, which is weighted average return on assets, WACC and IRR reconciliation. So what is VORA? So VORA is the return earned on assets of a business, on all the assets of the business. So in our case, the example that we have, the working capital have a 5% return, the fixed assets have a 8% return, and the trademarks, customer relationship technology return is put in by us uh, as a valuers. So now such returns weighted average by their fair value as part of VP exercise should equal to the business return, which is WACC or the IRR. So one way is that we put in a return for the goodwill by reducing the VORA from the WACC. But what generally I prefer, or what I've learned from the Big Four practice, that the back calculate the return on goodwill. So in our case, what we can see here, the goodwill return is 20%, which is back calculated in the present case, while the working capital return, which is less risky, which is less than for 1 year, and should be at a lower rate than fixed assets. Then the higher return assets are fixed assets, since they are tangible and should have a lower rate than intangible assets. While trademarks in our case are at the WACC only, while the customer relationships and tech, they have a higher risk. They might have a longer life and the cash flow might be uncertain. So if you see the flow, they're all making sense. And similarly, now since the goodwill return is higher than the business and the other assets that we have valued in the PPA exercise, the whole valuation and the asset return that we have put in is making sense. So this check, if you're not doing it, the auditors would do it. They would question you to do it. And even if it is not making sense, they will ask that either the valuation is not right or the discount rates that you have used are not making sense. So you have to make those adjustments back again. Now, this is the VORA and the WACC reconciliation. But there is another reconciliation in the PP exercise, which is WACC and the IRR reconciliation. So, what is IRR? IRR is the present value of the future cash flows, uh, and that at which rate such present value is equal to the purchase consideration. So, ideally, it is the implied business return. So, if the WACC and IRR are equal, it means that the forecast that we have used is at market participant basis, and the purchase consideration is at fair value. If the IRR is higher than the WACC in our PP exercise, then either the forecast that we're using has buyer specific synergies, but where the synergy should be market participant. And the fair value of the consideration might be lower than the fair value. The third case can be the WACC is higher than the IRR. It is a case of bargain purchase generally. So most commonly, the VORA and the WACC reconciliation should be there, and then the WACC and the IRR reconciliation to support that the whole exercise is on a market participant basis and everything is on a fair value, which can be supported. In mostly cases, what I've done, the WACC and IRR generally are not equal in a transaction. There is a difference, but that difference can be can we can have a band up to which we can approve it. I think the industry generally follows a 1% or 1.5% band, in which they are comfortable with it. So now we have discussed the VORA, WACC, and IRR reconciliation. We can discuss some pitfalls in the other common mistakes or some key essentials of a PPA. I will try to cover it up in a quick manner since we are already taken almost all the time. So, what is staff factor? We have already discussed that whenever you recognize an intangible asset, it will get amortized, and anytime an intangible asset gets amortized, there will be tax savings on that amortization. So, such tax savings should be included in the intangible asset value. So, when it applies, so every country has its own tax amortization rules. So, for example, in India, the goodwill is not amortizable, but technology brand are. So there should be a tab value on it. But in the US, goodwill is also amortizable, so there is a tab value on that also. Then while calculating the TAF factor, there is one input which is, well, there are two inputs which are very essential. One is the useful life of the asset that you use for calculating the amortization factor. So you need to refer the tax rules for it. So one of the easy source that I use is there is a PwC tax summaries which is publicly available, and I think everyone generally in the industry also puts a reference or a source asterisk in their reports for it. So it gives that what is the useful life. For example, in the US, all the intangibles have a fixed useful life of 15 years. And primarily in the UK, I think the customer relationship has a fixed life of 5 years or maybe 10 years. Um, the second key essential input of a TAP calculation is the discount rate. So discount rate should be in line what we have used in the intangible asset valuation. It can't be the book discount. Sorry, the discount rate that we have used in for the business. It should be asset specific discount rate, which should be used, and the tax rate should be the statutory tax rate of the tax rate as per the tax rate should be the marginal and not the book tax rate or the book effective tax rate. So if you fail to include the assets will be undervalued, then there can be a chance that Vora won't work or Vora would fail. So there won't be reconciliation. Then there is a red flag to the whole valuation, to the PPA valuation. So second, one of the most important point is the attrition rate, which is a key essential of a customer relationship valuation using the mean method. So there are generally two approaches, and why it is important. Once you apply the attrition rate in the method, the auditors would definitely ask you that uh, how you have determined the attrition rate and how you have applied it. So let's see how to calculate the attrition rate first. Generally, the attrition rate is calculated based on either count based attrition or revenue based attrition. So, what is count based attrition? So, in case uh, in the previous year you had 100 customers, in the current year now you have 90 customers out of those 100. So, there is a 10% attrition. But this is not as simple as it looks. Generally, a one data point doesn't support any assumption. So, what we do in industry, we generally take a customer list from last 3 to 5 years, and we apply a CAGR. For example, in the in the fifth year, how many customers are there and how many are right now. We take a CAGR factor. Similarly, for the fourth, third, and second year, then we either take an average or a median. But what the shortcoming of this method is, so if you can imagine, a customer loss of 100 rupees is not as important as customer loss of 1,000 rupees. So this is a question which every time would come in from the auditor if you apply account based attrition. That is the average sale value same for each customer? Is the average ticket size same? So if you can collect that, if you can understand that, if the ticket size is same, then each customer loss is as equal as any customer loss. So that is the important factor that you need to check while applying this count-based attrition. The second method to calculate the attrition is the revenue-based attrition, which overcomes the shortcoming that the count-based attrition had. So for the revenue-based attrition, we check the total revenue and not the customer count. So in case in the past, in the third year, there was a revenue of 100 crores by maybe 10 customers. So how much revenue is there in the current year by those 10 customers only? So if there is a loss, then that would be attrition. Then there we can calculate a CAGR from the last 3 years. Similarly, exercise is done for second and the first year basis, and then there is a median or average which is taken. It is the most statistical point and most widely used in the industry, which is revenue based attrition. So once we get the attrition, so I think generally people might take it directly, apply it directly on the revenue that if its attrition is 10%, let's reduce the 100 rupees of revenue each year, that fix it, fix the attrition by value. But it is a SLM method and generally not much recognized or much supported in the PPA exercise, because it's not practically possible that the same amount of customers leave each year. So generally preferred method is the written down value method, in which if you have a revenue of 100 in the first year and the attrition rate is 10%, is always applied to the closing balance of the last year. So then the second year we'll get 90, in the third year we'll get 81 revenue. So it's more practical, it's more logical, and it's more widely accepted in the industry. So one of the one of the factors that we use in the customer relationship valuation is the attrition, but there's an indirect derivation which from the attrition also for the useful life. So you can't take a useful life of a customer relationship for like maybe 20 years, maybe 30 years. So there are many of the methods to determine a useful life, but one of the indirect method, or a, I would say, reasonableness check, is the if you're using SLM basis attrition rate, you can you can use 1 by attrition rate. For example, if attrition rate is 10%, the useful life of the customer relationship in that case can be 10 years. If the attrition rate is 20% on WDV basis, the useful life for the same asset can be 20 years. So this is a reasonableness check. Obviously, it is supported by some other benchmarking, which is done through the similar transactions in the market. And I think I've covered one more point, which is related to the customer attrition in this slide only, not to the attrition, but to the customer relationship valuation, which is, in case you derive a customer relationship useful life of 20 years using the WDV method. So when we are all the finance professionals are here, we know that in WDV method the percentage never goes zero. It's fractional, but it always keeps going. So how much of the cash flow should we take in our valuation? So a person, or a rookie person in the PPA would generally take a 20 years cash flows. But what is followed in the industry and what is said, that there might be cash flows still left attributable to the customer relationship post their useful life. So how to check until which stage or until which year we need to consider those cash flows? So there is a method, or there is a industry norm that in all the PPAs you would see, that until the incremental cash flows of each year are more than 1%, or some values use 2%, they consider the cash flows into the value of that specific asset. So for example, there are incremental cash flows more than 1% till 30th year. I will take the cash flows, I will take the value for whole 30 years. But for the amortization purposes, I will use the 20-year useful life. So hope this is that the customer relationship bit is clear. I think the last topic for the session is determining the useful life. So now the methods what we discuss is for the customer relationship, which has one of the factor attrition rate and direct calculation of the useful life from there. And similarly, there is for technology, in which you can use the obsolescence rate. Now, how to first set a value for an intangible asset is that start discussions with management, that what are their plans for the asset, what they think that at which period they might stop using that asset, or whether a specific contract, how much life does that specific contract has, or there might be a brand which the acquirer might be planning to phase out in next 3 to 4 years. So ideally such discussions help you lay the foundation for the useful life. Then once you have a estimate for the useful life, you can support it using the PPA benchmarking exercise. That is a what is PPA benchmarking exercise? So we generally look for a similar transactions in the industry, and and the whole exercise is easily available, and we can easily do, even we don't have the softwares. For example, there is a tech company sale, and you put a 20-year useful life to a brand. So for a PPA, in a PPA benchmarking exercise, I will look at the annual reports of some of the tech companies in India, uh, and they are easily available on their website. For example, let's take a like an annual report of Infosys. You will might find a tech company, and they might have done an acquisition in last 3 to 5 years. So they would definitely have put in the value or all the whole PPA disclosure in their annual report, along with what is the useful life that they have considered as part of the PPA exercise. So it is one of the best estimate or the reasonableness check that we can use, that we can have in our PPA exercise as a support, to support our useful life. So similarly, we can build a range. We can refer to, there is not short that there will be one transaction. There can be 5 to 6 transactions. We can create a range. We can benchmark our useful life that we are using in our whole PPA exercise. The second important factor about the useful life is that we generally misjudge the indefinite useful life with the infinite useful life. The indefinite useful life is just as that we can't define the useful life right now. We might use this brand uh, to the infinite, but we are not sure. But this brand might have a 30-year useful life, but we are not sure. But in that case, that indefinite useful life asset is checked for impairment each year, reassessed for impairment each year. And also the assumption for the indefinite life is also reassessed each year. So ideally, in nutshell, useful life is generally an outcome of your discussions with management. Uh, what you think of. Third is a PPA benchmarking, and then there are some reasonableness checks with attrition rate, obsolescence rates, or there might be a fixed intangible life based on the contracts, maybe patents, maybe licenses. So here, summing up today's session on the intangible assets and PPA valuation, and how we discussed when the PPA is required, what is PPA, what are the intangible asset definition of it, what are the common categories, what are the common methods, and some of the most used methods in the PPA exercise. And the last topic, that some of the essentials of PPA exercise. If you have any questions, I can take up. And also, you can connect on me, you can scan the QR.
Thank you, Arun, for a very elaborate presentation on PPA, various aspects of PPA. I will say if any of our audience, any of our participants have any question regarding the discussions that we had in last 1 hour, feel free to unmute yourself and ask the question. Or in case if you wish to listen it again, we would be uploading the entire session on the YouTube channel, which is Gaurav Garg, the Knowledge Cast, in a day or two, because for next 2 days we would be off. So maybe by Monday we would be uploading the session. So thank you, Arun. Thanks to all of you for joining. Thanks to Arun for making a wonderful presentation. Good luck and a happy weekend.
Thank you everyone for attending.